Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello and welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host, and we're glad to have you back. Hey, if you wouldn't mind, please, if you haven't done so already, go ahead and subscribe to the podcast on any one of 30 different channels. The big ones, of course, are Stitcher, iTunes, iHeartRadio, Apple, Google, you name it, they're out there. And while you're there, go check out globalinvestoragent.com. We just created this website that helps showcase all the agents that we've trained to become investor agents. These are not typical agents. They're trained to identify, analyze, and negotiate on and off market deals, which is really big for us investors. And they have the tools to do it. They have access to every single parcel in the country. Doesn't matter what city they're in. They've got access to every single, doesn't matter if it's a stamp-sized outhouse. They know how to get to the people and the property. So this is a big deal, and I suggest you take advantage of it. If you're an agent, you should definitely jump on this bandwagon here. I mean, it's the way the market's going and the way the economy is, and you really need to build out this part of your model, guys. I mean, I'm speaking to you from the heart because I've seen it before. Now's the time to learn to do this. Don't wait till it's a necessity. Do it. Be prepared. It's the old Scout motto. So, speaking of being prepared, got a great guest today. Kent Ritte. Kent, first of all, thanks for joining us, man. I really appreciate you taking your time to share your wisdom with the group.
Absolutely, Gary. Thanks for having me on.
Yeah. Hey, would you mind giving people a little bit give them some backstory. Tell us some good, juicy stuff about who you are and how you got there, and then we'll jump into some case studies, perhaps.
Yeah, happy to. So I started out my career as a management consultant, living in Chicago, and as a management consultant, really what I did was I helped people solve problems, businesses solve problems that they couldn't solve themselves, and in doing that, got really good at understanding businesses, got to see hundreds of different businesses and how they operate, and really got to see kind of the good, the bad, and the ugly, and really started to identify some key themes on really what makes businesses work and what makes businesses not work. And the reason I say that is because really that has informed a lot of my real estate investing. And so, I took that education, and then in 2010, a few colleagues and I left and started our own business. We started a management consulting firm, a boutique firm, and we ran that until 2015. And we'd grown it to about 30 million in annual revenue and 95 employees. And we decided it was the right time to exit. So at the end of 2015, we sold that business. And that's really what kicked off my real estate career. I had capital from that exit. I was really looking for the next adventure. And I was really started investing because I was looking for diversification. I was looking for alternatives to the stock market. And, as I looked at different asset classes and different investment types, real estate really checked all the boxes for me. It had that non-correlation to the stock market, had cash flow, had appreciation, had tax advantages, all those things that you want. And so I really dove into real estate head first, but first really as a passive investor. And I spent really from kind of mid 15 into mid 19, so about 4 years as a passive investor, investing in other people's deals and just learning and doing some small stuff on the side, some singles and flips and things. But it wasn't until 2019 that I had gone through enough courses and had enough coaches and listened to enough podcasts and read enough books and gone to enough seminars that I felt confident that I could go out and acquire a large property on my own. And we did that in 2019 with a couple of partners, went out and acquired 250 units in Atlanta. And that was really the start to my business now, which is Hudson Investing. And now we're working on deal number 10. And they're all syndications. And we're just rinsing and repeating a model that we know works.
Yeah. Well, that's pretty awesome. And a couple of things you touched on is when you started in 2015, that was a great time to get started because we were, for the most part, out of the last recession. There were still some, what we call shadow inventory on some of the bank's books that had to be dealt with. But it wasn't anything like it was 4 years prior to that. And the other part of it is, the ensuing 4 years, 2016 and on, was probably the strongest economy. According to almost all experts, the strongest economy we had in the history of the country. And then unemployment for all categories was as low as it was. It was an absolute great time. Here it is now, 2022. And we're still going strong in spite of all the things that are happening. Rising interest rates, rising inflation, trouble in Europe and things like that. It just goes to show you how resilient our economy is. Now, I'm not saying we're not going to have our correction. We definitely will. But everybody listen, having a correction, i.e. recession, is not the end of the world. It's a natural part of the economic business cycle. When you learn to understand it, you'll know what strategies to use. It's not like you stop, you just change strategy. So I don't want to go too far down a tangent. I want to stick with Ken here. So Ken, going back to your discussion, you also mentioned Atlanta, and obviously you're from Indy, and you spent time working in Chicago. As far as what you're doing when you're doing syndications, are you looking? Do you have a formula? Like, what's the formula? Mostly around Indiana and Illinois, or really geography's not that important? It's just where the best deals are. You could kind of fill us in there a little bit about the kind of what it is you're doing. That would help too. If you don't mind sharing, that'd be great.
Sure. Yeah. No, geography I think is extremely important. I think one, it's just, while you can definitely hop on a plane and go and acquire properties all over the country, that just wasn't the model that I wanted to develop. Part of the reason that I wanted to get into real estate, another reason I really hadn't talked about yet, is because I had a growing family at the time. I mean, now I have three kids that are 6, 4, and 2, and still very much a growing family. But at that time, really I had just kind of my newborn. And that really was a pivot point in my life to decide, as a management consultant, you are traveling almost every week, if not every single week. And really just that pivot point was, I didn't want to do that anymore. I didn't want to be gone. I didn't want to be an absentee father. I didn't want to live that life on the road when I had a family at home. I wanted to spend time with my family because I love them. And so I knew I didn't also want to be hopping on planes all the time to go and look at properties. I wanted to be able to spend time at home. The whole reason I say that is because the way that I defined my geography was really kind of drawing a 3-hour driving radius around Indianapolis and saying, okay, here's where I'm going to hunt for properties. And that includes a lot of great cities. I couldn't do that if I was in an area that didn't have great investment cities, but Indianapolis in and of itself is a great place to invest. Other cities that includes would be and where we currently have property, are like Louisville, Kentucky, Lexington, Kentucky, Dayton, Ohio, Cincinnati, Columbus. We don't have property in Columbus, but Columbus, Ohio, another great market. And then a lot of other great markets in Indiana. And so I felt like it was a really target-rich environment right in my backyard. So instead of thinking I was going to fly across the country and try to compete in the Southeast with everybody else, with almost everybody else, I felt like I could, from a strategic standpoint, one, have a better home life and be home, not have to be hopping on a plane. Because after 12 years of being a management consultant, I've flown about as much as I want to. I'm pretty good. And then just knowing that everybody else is looking in those markets, that I could provide investors some geographic diversity into the Midwest. And also just kind of by luck of the draw, the Midwest has really caught fire as of recently and is really starting to see some amazing growth. And we're seeing that in job growth and rent growth. And I mean, as I saw, Indianapolis was on a report for having the lowest unemployment in the country. Nice. And so I just, I'm blessed to be in an area where I can find great opportunities in my own backyard. And so I thought, why go somewhere else if I can find them here?
Yeah. What's interesting is it sounded like mostly that radius took you into Indy and Ohio, which makes sense. But what about the other way? There are smaller, even tertiary towns like Champaign, Peoria, Illinois, or they those on the radar screen at all? Or
no, I don't have. I just stay out of Illinois.
Okay.
Too many political and tax landmines, and I know that, and I can say that because I lived in Chicago for 12 years, and I lived that, and after selling my condo in Chicago and remembering what I thought I was going to get, and then what I actually got after we got to the bottom of that closing statement, I was like, nah, I've had enough here. I think, look, I mean, I like to work in states that are business friendly. I like to work in states, both from a legal standpoint, but also from a tax standpoint, and Illinois, in my point of view, is not one of those.
Yeah, no, I agree. There's an interesting website. It's called howmoneywalks.com. It's basically using IRS tax returns to determine what they call money migration. So it's not necessarily people, it's where people deploying their financial assets. And, clearly Illinois' money's, we call it a red state, not political red, but red as in money's leaving Illinois. It is going to, the other states that are green, and Indiana is one of them. But what about I've never invested in St. Louis, although we have agents in St. Louis, but in Missouri, is that any better, or is that part of the radar screen?
No, not St. Louis. I mean, I just don't know St. Louis that well, honestly, but I can't say a lot about it. I know that the rents in St. Louis are higher than the rents in Indy, which kind of surprises me, but I think it's just, I don't know enough about it. I think where we will continue to expand will be places like Kansas City, and then down into really the Southeast. So, now we're looking, continuing to look heavily in Indiana, Ohio, and Kentucky, but also down into Eastern Tennessee, Northern Alabama, and Northern Georgia. And, we still have some roots down there and some good connections. And we're working on actually a ground up development in Northern Georgia right now.
Nice. Yeah, there's one of my students actually has, I think it's 27 acres right on Lake Lanier. And it's, just a bedroom community for Atlanta. Yeah. And he and his dad are actually developing that. So good deal. Nice. Yeah. And also Huntsville, Alabama, one of the best areas. It doesn't get a lot of attention, which is good for us investors, but a huge military base here. They call it the Pentagon of the South, actually. And it's that there's an area to the west of it, I think, called Madison, small town to the west of Huntsville. Excellent areas to invest in,
Yeah. So, yeah, I'm familiar with Huntsville. Yeah, they're great areas.
Yep. Okay, so now as far as are you using data, like published data from, say, Marcus Millichap's, of course, a 800-pound gorilla in the world of commercial brokerages, that their specialty is multifamily residential. They have lots of good reporting, but what resources are you? Anything that you can actually say that's public, that's available out there that people can use? So so things you're looking at, crime rates, cost of living, cost basis versus rents, all those critical things that we like to look at. Are you any particular favorites you wouldn't mind sharing with the group?
So as far as the metrics that we look at, or with the data sources?
Yeah, data sources. And then what metrics do you use too when you're actually
Sure. Well, so data sources, we subscribe to a lot of data sources. There's, the CoStar is just pretty synonymous, right? ArcGIS, which is good for more of a demographic type data and looking at, market studies and things. Those are both services we subscribe to. There's an economist I really like named Peter Lindman, and he puts out a quarterly newsletter that I think is just fantastic. It's all focused on commercial real estate and trends and where things are going. So it's another thing I subscribe to.
It's Peter Lindman?
Yeah. I think it's Linnenman. He's a professor at Wharton, and he's just a brilliant economist, but focuses on commercial real estate. Those would be our main data sources. We can pretty much get anything that we need there. And then from there, it gives us the ability to kind of dig deeper. That's where we hit Google. Right. That's where we start making phone calls and want to really understand the area.
Okay. So what kind of metrics are you generally looking for? Is it uniform across the markets, or would you apply different metrics to different markets based on their industries and history and things like that?
Not different metrics to different markets. I think different metrics based on different asset classes and different strategies. So for example, you would look at probably different things, some similar, but some different if you were going to, and you would definitely weight them differently if you're going to do new development versus if you're going to do value add. Differently if you're going to buy a class A versus if you're going to buy a class C, right? But it's funny because I actually kind of codified this for the first time, but I have about, I think it's up to maybe 34, 35 different metrics that we look at and identify and benchmark for any property that we're going to go after. And so the list has gotten to be pretty robust, but it's all things that can impact your property, whether it's, I think it starts with simple things like job and rent growth, right? I think rent growth and job growth are highly correlated. You want to be somewhere that's growing. You want to be in a market that's growing because the rising tide raises all ships. It's really difficult to invest in a market that is shrinking and contracting. And so look for job growth, look for job diversity. So you're kind of looking for where are things now and you're looking for where are things going, right? So you want job diversity, meaning that you don't want a town with one manufacturer who might go out of business and the whole town's out, right? You want good diversity, you want good growth. You want affordability, relative affordability. So you're looking at rent to income ratios. How much of people's monthly income are they spending on rent, right? And we want that to be somewhere in the low to mid 20s in our properties. And then we do that before implementing our business plan, and then look at it, post rent bumps on renovation and things to know where we're going to end up. You want to look at proximity to things like interstates, to path to progress, and that'll tell you a lot about the location. Is it close to a Dollar General or is it close to a Starbucks? Right. Yeah. Because those retailers target totally different demographics when they're going to put their stores in place. And so, you look for things like that. Gosh, I'm trying to think of a few more off the top of my head, but I think those are some good ones for folks to start with.
We'll be right back with the Massive Passive Cash Flow podcast after I invite you to Monday Night Live. Every Monday night, 7 p.m. Eastern, I teach a class without fail for you on subjects ranging from flipping to buying rentals, managing rentals, wholesaling, commercial, creative purchasing techniques, analyzing properties, identifying properties, hundreds and hundreds and hundreds of subjects. And if you are a licensee, if you have a real estate license, you should definitely tap in because there are a lot of investor agents also in the class. Many of them are on the global investor agent team. So you can learn from them as well as from me how to actually work with investors correctly and profitably. All right, we'll see you Monday night. The link is in the show notes. Go ahead and register. We'll get right to the Massive Passive Cash Flow podcast. Yeah. Now, those are definitely good metrics. I know the rent to income ratio. That's one of the first lessons most investors make. Is you gotta have places that people can afford, because if something happens, two-owner family and one of them gets laid off or something, you want to know that they can still keep the ship afloat. It's a human relations business because we're providing one of the three key things, which is food, shelter, clothing. We're providing shelter. And so we're inexorably tied to the human drama. Whether directly or indirectly, we have to keep those factors in place. What happens when crisis hits? And if you're in a certain demographic, it could be disastrous, But so I appreciate you sharing that. I know a lot of people listening there. These are some of the common questions they have. Well, how do you know it's a good area? How do you determine if the property meets your criteria if you're a good investor? And all these things really matter because you're buying. You have to have one eye on today and one eye on tomorrow. You're buying today, but you're not just buying for today's income. You're looking at, okay, what's this likely to do? How is this going to perform 3, 5, and 10 years out? So we like to look at zoning plans. We can also look at like government grants that are being offered and things like that, and we'll see what are those areas, because we know historically you're probably looking at could be a 30-year trend, zoning, if you see they're building a major highway artery, for example, that's always those things are generally 30 years out anyways. With the people that buy land there are the ones that are going to do quite well when that development starts. So all those things are really important. I wish I could tell everybody listening, here's 3 things you need to know, but you really kind of need to know everything, and you will over time. So let's go back to the beginning. Speaking of time, I think you started in 2015. If you wouldn't mind, describe the first property you bought, and then we'll move forward and to maybe talk about the last one you bought, and let people see kind of the progression you've made. If you wouldn't mind sharing,
Yeah, sure. So, first property from a multifamily standpoint, it was bigger. It was the 2-property portfolio. It was 250 units total. It was 100 unit and 150 unit property.
Mm-hmm.
Before that, I had, like I said, done some singles and some fix and flips and different things, and built up a small kind of single family portfolio. But yeah, we went kind of big out of the gate. I was able to do that because I partnered with great people. I partnered with people that were more experienced than I was. And I think that's a great way to get started, is to find people that have more experience and learn from them by adding value within the deal. I was doing analysis. I was, doing some asset management work. I was, raising some capital. We were doing, all kinds of different things just to help out with the deal.
Nice. And it was, so when you bought that, was that inside the belt, or was it outside, or where was the complex?
So one was in Norcross and one was in Lanier.
Oh, yeah. So you're way up Lanier also. I like the Lanier area, I just, the last time I was there was last summer, actually.
Yeah.
Went to dinner at Mary Mac's in downtown Atlanta, greatest restaurant on the planet. And then up in Lake Lanier, had dinner at one of my students' houses right on the lake. So a lot of people are moving up there in droves, and they're willing to do that hour commute so they can have more peace, Yep. So it's an amazing area. Okay. Now, so when you look at that, that's been almost 7 years now. How would you describe, like, what was the cash flow and the cap rate when you bought it, and even the cash on cash return, if you remember that, and then what is it now? Because I want people to see that the best time to buy real estate is now. It doesn't matter when now is; it's always going to grow. But yeah, do you remember what those numbers were when you?
Oh man, you're really stretching me, Gary. I think it was. I remember it was an 8% preferred return.
Okay.
I know the cash on cash was covering the pref, because we were 8% or so in year one. So solid cash on cash. And then, I know that we were able to grow the NOI over the first kind of 18 months or so by about, I think it was 15% on one property, about 30% on the other property. So significant growth. And it ended up being about a 25% IRR back to the investors. Okay. We only held it for 2 years. It was kind of an in or out, and the market just exploded, and got a great offer, and took it. But, right. But yeah, I mean, cash was strong. I mean, cap rate was oh gosh. It had to be, I doubt it was 6, but it was definitely probably mid 5s. I'm sure it was probably mid 5s, which now in Atlanta, it's 3.5, 3.25. Yeah. So, things have changed quite a bit.
Yeah. Well, what's interesting, I want everybody to pay attention here. So when Kent answered, he mentioned the cash on cash first. He didn't get to the cap rate till later. And the reason is most investors start off thinking cap rate, which is what everybody's taught. But the reality is, and this happens every conversation I have with the seasoned veteran investors, cash on cash is really, that's a more important metric. Cap rate really kind of reflects the area, that's reward versus risk. But the cash on cash return is your actual performance. It's money out of your pocket versus money in your pocket. And you can negotiate terms to improve the cash on cash return. Okay. Cap rate will improve over time, assuming your raise your rents and other factors remain the same. But no doubt about it. That's the cash on cash return that really is to me the key determining factor, especially on the bigger properties.
Yeah, I think that's right. I mean, I think especially in the market now where there's just a lot of moving parts, that there's a lot of risk just because there's a lot of uncertainty. We just don't know exactly what's going to happen. I mean, I have my points of view, but a lot of people have different points of view. So I think in a market like this, all markets, but especially a market like this, you have to be more careful. And I think there's safety in cash flow. I mean, as long as you can cash flow, as long as you have a solid debt service coverage, you can live to fight another day. I mean, the only way you're really going to lose that property is by defaulting on your mortgage. Right. And so if you can have strong cash flow, I mean, even if there's a dip, I mean, you mentioned recessions at the beginning of the call. The comment that I was going to make is, if you're a long-term investor, you really shouldn't care about recessions, because the average recession is somewhere between 11 to 16 months. Mm-hmm. And what happens on the other side of a recession is if you look back through history, every time things have gone up on the other side, that's kind of a culling of the herd that occurs, if you will, cleans things out. So as long as you're not caught needing to or with a balloon payment coming due right in the middle of that recession, then you'll be in good shape. Right. Because they really don't last that long. And if you're working on a 5-10 year horizon, you'll be fine.
Right. I agree 100%. Yeah. So what are you seeing looking ahead? I mean, maybe in the Peter Lemon report, I've heard people say that really, they know we're going to have a correction, but again, it's just part of the business cycle. You eventually get used to it. But some folks are actually saying they don't really think it's going to be this year or next year. I mean, a lot of people are saying that, but I think the big capital players, they're looking at more like 2025, and I don't know all the reasons why. I think that one of the reasons is there's obviously a demand still far exceeds supply right now in real estate, so we clearly got to build more. So that might counter any economic factors affecting the economy. But what are you thinking along those lines? I'm not, and this isn't like a test, or we're trying to, hey, if Kent said this, we just like to get different perspectives, So.
Yeah, no, that's all good. I think that, I don't think a recession's coming in the next couple of years. I think we're more looking at like a 5 to 6 year horizon. Mm-hmm. I think that asset prices are going to stay strong. I think we're still going to continue to see a lot of appreciation. I think that whatever happens with interest rates, because interest rates are going to go up in the near term, but I think interest rates go up this year, they go up next year, and then I think they start to come back down, because I think as soon as the economy starts to cool, the first lever the Fed's going to pull is to bring interest rates back down. Yeah. So, even if you look at forward curves on things like the SOFR rate, and it has them going up to like 5.5 in the next 18 months, and then it has them coming back down pretty sharply. And those curves are never right. I mean, they're just a prediction, right? But if you look at that, you look at the 10-year is not moving nearly as fast, but it is edging its way up. But we're talking about, like, I think you have to look at everything in historical context. We're still talking about extremely low interest rates relative to the 80s and 90s, and still interest rates that you can very much operate, these properties in and pay pretty decent prices in. And so I don't think anything with interest rates really impacts buying and selling a real estate. I think that the amount of money available, just the money that's been created, the dry powder on the sidelines, and the amount of money chasing yield that doesn't exist in other investment types, all coming into commercial real estate, particularly multifamily, industrial. And then if you think about all the money that was already in commercial real estate that was investing in office and retail, that now is investing in multifamily and industrial, there's so much cash chasing these deals that I think you're going to continue to see asset prices increase for multifamily and industrial, for mobile home parks and self-storage and all those, all kind of the hot sectors right now. And I think from a risk standpoint, I think one of the biggest risks that people will face, and it won't be nationwide, it will be like hyper located in certain markets, but it'll be supply supply risk. I think it'll be oversupply.
Mhm.
You know, I think that in some markets we're building like crazy. In other markets, you know, we're not building all that much. That's honestly one of the reasons that I like the Midwest as well, is that there's not, relatively speaking, there's not a whole lot of building going on here. So we see vacancy rates in our markets of 2 to 3%. There's just there's nowhere to go. And so, you know, because new supply is going to be your competition. So I think as long as you avoid being in markets that are going to become oversupplied, you should still see good growth for a long time to come.
Yeah. You know, it's amazing. I currently call Florida home, and I'm on the Gulf Coast just south of Sarasota, but I have a lot of all those agents I've trained. There's a big number of them in Florida because everybody's coming to Florida, it seems like. So it's easy to get business here. But what I was getting to is in Miami, if you ever fly into Miami, all you see is a sea of cranes, you know, they're just constant building skyscrapers. And we got what we call it the state flower is the construction crane, you know. Mm-hmm. So it's going crazy. But clearly the state of Florida, Georgia, the Carolinas, even again into Alabama are all doing great. Texas, Arizona, you know, Nevada, oddly Colorado is doing great. And this sounds crazy because California is people are leaving in droves. They're just because of the political and economic climate there, they're chasing away business owners. They're just like it's like an anti-business owner. I'm probably going to get myself in trouble for saying this, but the facts bear it out. I mean, the money's leaving by the billions every year. I don't know how they keep raising taxes. I don't know how they can keep going. But then you look to the north, Oregon and Washington are some of the green states where the money's going to, you know. There are some quiet ones. There are some sleepers like Idaho. Coeur d'Alene, Idaho right now is one of the best places you can be. It's beautiful. And people there keep saying, please don't say that. Keep it. We want it to be kept quiet. You know, so, but, you know, people wouldn't normally think of Idaho, but it's a pretty awesome state, you know. So mostly it's all around, we call the Smile, the coastal states. And then there's some interior states too. Just not many, but in any case, so going forward, how do you see your strategy changing, or how, like, if you could, I know we got a few minutes left here, if you could discuss at the how you're structuring your deals. It's a syndication, sort of like what the REITs have done. And REITs have the same philosophy. They'll buy something that has a value add. They can raise the rental rates, and they know, you know, anybody listening probably knows this. Your value is you know, based on cash flows, based on net operating income approach to valuation. So as you raise rents, your cost basis typically is relatively fixed. So it's all top line. And so the values go up dramatically. But as far as structuring, back to the original question, do you have a favorite strategy for structuring, like some of it's equity share, some of it's profit share, some of it's just plain interest on debt, or how do you approach that when you look at a deal, you know?
Yeah, I mean, we keep our deal structures pretty simple, pretty vanilla. I mean, we'll offer a preferred return, and then we'll split the profits above that preferred return. So, I mean, we just keep it real simple. You know, like I said, I started out as a passive investor. I started out investing with other people, and I hated the really complex models because I didn't feel like I could do the math myself. Mm-hmm. And if I did do the math myself, I would come up with a different number than maybe what the sponsor had, and that's never a good situation to be in. So we like to keep things really simple, so that everybody knows what they are owed, and we know what they're owed, and you know, it's just one less conversation to have. And so, yeah, I mean, really, our deal structures are quite simple.
Okay. Well, cool. Well, I'll tell you what, we're probably right at the half hour mark, maybe a little bit over. So for people wanting to, if you don't mind, pick your brain a little bit and then discuss maybe some deals with you, because we do have a lot of investors obviously listening. What's the best way to get a hold of your, you know, website they can go to gather information, you know, free consultation, anything like that you can share, I'm sure will be appreciated, you know?
Yep. Folks can go to my website. It's kentritter.com. And they can also check out my podcast. It's called Ritte on Real Estate. It's, you know, right up there next to yours, Gary, on all those great podcast sources. And, other than that, I'd say you can find me on LinkedIn if you want to message me directly. But I'm pretty accessible. But yeah, my website is really my home base, and we've got all kinds of stuff on there. We've got a blog, we do a lot of videos, the podcast, and then just some new investor area with terminology and FAQs and things to help people get started. Awesome.
Okay. Well, thank you. And everybody listening, just remember KentRitter.com. Okay. Check it out. Look at the resources there and reach out to Kent. Also on LinkedIn, and check out the podcast too, Ritter on Real Estate. And while you're there, after you're done listening to this one, please do Kent a big favor and leave a good review. This is the currency of podcasts. It's basically, we put this out there to the world. You don't have to pay for it, of course, but you could reward Kent with a good review. So we really appreciate that. And while you're there, and while you're there checking out KentRitter.com and doing the review, go ahead and go to globalinvestoragent.com. And lately, I'm really pressing the real estate agents. Go on there and get click on the link. You can set up a call or gather information. Really, really important heading into the future here that you make this part of your model. You'll find out either the easy way or the hard way. Better to find out the easy way now than the hard way later. So in any case, have fun doing that. And in the meantime, we'll see you next week on the next podcast. And take care of yourselves. God bless you and your families, and stay safe.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.